UiPath is down 5% just over the last week, and year to date this is down now more than 50%. It's trading towards its 52-week lows and has massive amount of upside, and one that I'm considering adding into the portfolio. Now, when we take a look at this company, some of the reasons why it had struggled. First thing to note, just this week, they have announced they are laying off 10% of their workforce as part of a company-wide restructuring program. News that you are probably familiar with is that in May, the CEO announced that they were resigning effectively from June the 1st, which definitely hasn't helped things for this company. Now, when we take a look in terms of the actual layoffs, they will be implemented in the first quarter of 2026, so there is some quite way away. When we look at their previous earnings, how they performed, well, actually they reported a lot better than analysts were targeting in terms of the earnings per share and their revenue. However, one thing that really did hurt this company's performance was in fact that they did lower their guidance for the full year. They also announced that these layoffs are going to cost them around 15 to 20 million. And again, this isn't the first time that this company has announced some massive job cuts, as we can see 2 rounds of these in 2022. Now, just a quick reminder for those that don't know, this company essentially is a software company that does automate repetitive tasks and does look very strong and incredibly undervalued, especially according to these Wall Street analysts. As we can see, an article just from the end of last month, not that long ago, they have 2 cheap growth stocks that they do believe will soar incredibly just over the next year. One of these, in fact, is UiPath. And we can see Keith Wise at Morgan Stanley has outlined a bull case scenario for $35 per share. And again, we are talking about, in fact, under a year. This is essentially more than 175% upside from the current trading price. The main thing that we do want to highlight here is that even though that is their bull case, they believe that their base case is around $15 per share. Again, still showing some very nice upside over the next 12 months. When we look particularly at this company, some of their metrics that you need to be aware of before considering adding to their portfolio. Free cash flow per share, always we want to see this consistent increases over the longer term. Now, in positive news, it has gone from a negative, which we saw for the majority of the period from 2020 to 23, into positive in 2024 at 52 cents per share. We can see over the next 12 months, it is expected to remain flat. Now, in terms of sales growth, very strong double digits over the last few years. Just bear in mind that it has started to slow down from the great growth we saw in 2021. Nonetheless, 24% is still very strong for this company. Just need to ask yourself, and when we come to look at the margin of safety, whether or not we believe this will continue into the foreseeable future. And we can see numerically the very large growth it has had just over the last 5 years. One thing we always have to point out, yes, we love it when companies do share buybacks, returning excess cash, but we have to show you with Path, they have in fact been doing the opposite, diluting your position as a shareholder over the last few years. In terms of ROIC, we want to see positive 10% at a minimum. Give us faith, management are able to effectively allocate their capital. What this shows over the last few years, as we will come on to when we do the income statement analysis, they haven't turned a profit over the 5-year period. On top of that, that is very clear with the operating margin. It is significantly negative from 2020 to 2024. The only positive thing we can say is it has started to get smaller across the years. Ideally, over the next few years, we do want to see this as a positive, so we can see a bottom line showing net income and not a net loss. Free cash flow margin, on the other hand, as we saw above, it did turn positive in 2024. Nice to note, 22%, very strong. We want the minimum of 5%. Again, on a trailing 12-month basis, 24% is also something we do quite like to see. In terms of net debt to EBITDA, now yes, they haven't turned a profit, but one of the strong indicators of a great company is when they have a great balance sheet. We can clearly see that here, as these numbers tell us the number of years it would take the company to pay off all of their debt net of cash on hand. 0 over the last 3 years, 0 over the next 12 months, indicates it won't even take them 1 day to pay it all off. So let's take a look at that exact information. As we said, in terms of their top line revenues, it does look very strong. With more mature companies, we want to see 3 to 7% year on year. They've gone from 336 to 1.3 billion. And as we can see, it has been growing at a very strong rate. And again, if this does continue and they are able to sort out those margins, turning it into a profit, then this could be a great growth stock to consider for the portfolio. As we mentioned earlier, they have reported a net loss over the last few years, and unfortunately it is fairly inconsistent. Just nice to note, from 2022 it has started to be smaller and smaller. Let's hope that 2025 and beyond they will start to turn a profit. In terms of the health of this company, their total cash versus their total debt, well, as we can see graphically, it has increased over the longer term. In fact, numerically going from 232 million to 1.9 billion. When we then take a look at their total debt, otherwise that number in isolation doesn't tell us anything, we can see their total debt in fact is very small. It's gone from 26 million to 77 million. No surprises then when we did look at that net debt to EBITDA that it was 0. It won't even take them one day to pay off all of their debt net of cash on hand, and even though it is increasing, still very trivial in comparison to their total cash position. We then take a look at how they've performed in their earnings. So great to see, very good track record over the last 4 quarters, 100% beat, very nice to note. Then when we look at forwards looking, well actually over the next 4 quarters they are anticipating double-digit negative growth to their earnings per share, something just to consider whether or not you are satisfied with this and you do believe over the longer term they can turn this around. Nonetheless though, January 2026, if they can achieve that EPS estimate, their forward PE will come down to around 27.63. For context, S&P around 23. Now we'll take a look and see what that compares to in terms of the sector median. So valuation grade, they do get a B+. Let's find out where these numbers are coming from. First thing to note then, P on a non-GAAP basis, 32.8, so it is in fact above the sector median of 24.64. You're paying a premium of 33% for UiPath. Again, you could in fact believe that it is warranted, it is justified. We are going to come onto that and see whether or not we agree. In terms of the PEG ratio, well, we do see a 0.71, much lower than the sector median, hence why they get an A+. But again, it does really come down to what valuation method you do look. For example, price to book on a forward looking, they are trading again at a discount. If you look at an EV to EBIT, as we can clearly see, they are trading at a premium. We then move on to their growth grade where they get an A-. That is nice to note. And when we look on the year-on-year revenue growth, well, 23%. So we can already see why it should be justified to be trading at a premium. The exact number, again, that is something we'll look at the valuation. When we look forward looking, again, a lot better, 14% versus the sector median 7%. And the main thing that I really want to point out here is into the future, over the next 3 to 5 years, the earnings per share is anticipated to grow 47%, much higher than the sector median of 14%. So already off to a great start, but again, these are all estimations. It will come down to whether or not you do have faith in this company hitting those numbers. Profitability, always great to see these A's as we mentioned. A-, that is a very large gross profit margin of 85% in regardless really in whatever industry you take a look at. Probably one of the highest we have seen on this channel. Sector median 49%, but the main takeaway from here is they still haven't turned a profit, -6% with the sector median at 3%. On top of that, what is quite nice to note, however, is their cash from operations, 332 million, much higher than the sector median's 93. Well, firstly, they get a double hold rating from Seeking Alpha and Wall Street, and they get a sell from Quant. In terms of valuation, well, a B+, A- on growth with an A- on profitability. Now, what we always like to look at and understand, what are the themes we can see in the industry? How do they compare in the system softwares? We have quite a few companies that are very well known in this industry. And in terms of just over the last year, we actually see them as the worst performing. Now, remember, the majority of the hit of this share price was down to the fact that they did lower their guidance of revenue. On top of that, with the news that we just went through today, their sales workforce being reduced by 10%, that has hit that share price down around 5 to 6% just over the last week. Now, when we look over the last 3 years as well to compare, again, we can see they are one of the worst performing. But in fact, in this industry as a whole, all of them, bar just one CVLT, have returned negative over this time period. So you can look at it one of two ways. Great opportunity to buy a company that essentially the market has overreacted. It looks incredibly undervalued. Or maybe just the fact that it is down over the last 3 years, it isn't one for you. Just keep in mind that past performance is not an indicator of the future. And just for consistency of our deep dives, when we do compare it to the S&P, no surprises there, but over the last year as well as the last 3 years, the S&P has significantly outperformed. In fact, we're looking at a negative versus a positive. Just remember though, we want to be forward looking. Do we have that confidence in the next 5, 10, 15 years, whatever your time frame is as an investor? Do you see this company outperforming the S&P? If the answer to that is no, well then just look at an ETF like VO, low cost and just dollar cost average in. Now, we also want to point out we have released 18 undervalued stocks completely free in our weekly newsletter. You can click on the pinned comment below to sign up. We also get a free spreadsheet if you do click up as well, and you get access, which is instant, to all of these other articles to read as well. Moving on to insider ownership then, just over 22%, which is fairly high. We do see 26 million worth of sales by the insiders over the last year. However, a few things to note. First one is that in quarter 3, there has been no insider buying or selling. When you look at quarter 2, around 1.66 million. But the main thing that I want to point out here is that every single quarter over the last 3-4 years, there has been insider selling. So it is a common recurring theme, not something that has taken us by surprise. And we can in fact see the CFO has been selling shares, as we can clearly see. Personally, this isn't a bearish indicator. Look, but insiders will sell for many reasons, not necessarily because there are any issues, could be personal or financial. Now, institutional ownership at around 63%. We see 1 billion worth of sales over the last year. We see around 900 million worth of buys during the same time period, so not much between them. But what we do want to point out here, in the more recent quarter, Q2, a lot more buying by the institutions, as we can see. Now, main thing to understand here is that whilst we look at this information on both an insider and institutional perspective, always do your own due diligence, never copy their movements. Now, let's get into the valuation of UiPath. Now, our intrinsic value in today's episode does arrive at just under $18. Now, where we get this number from is we put the free cash flows into the DCF model, and whilst we see the average growth here at negative 368%, it is heavily skewed as we see 23 go from a negative to a positive. So we've gone for 3 different growth rates, which we believe to be actually very conservative: 6, 8, and 10%, low, medium, and high. Now, we've gone for the 8%, as we can see, and with our discount rate, we get the present value of future free cash flows and terminal value, which we add to the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and that is the intrinsic value, just under $18. And as we can see, that would give you upside of around 43%. Now, you can always grab a copy of this model by clicking on the pinned comment below, running your own numbers through, whether it's for UiPath or any other company. Now, look, just to make it clear, for example, if you believe that is too low and you believe 10% is actually more accurate, then you can see the intrinsic value would hit around $20, indicating 60% upside. Now, you could be a lot more conservative and say actually it should be 4%. We can see still undervalued, or a lot more optimistic at 12%. Again, we can see nearly double the current trading price. Today's episode, though, we do want to take that medium rate of 8%, which we do believe to be fairly conservative over the longer term, and we get our intrinsic value at $18. Now, before we look at our margin of safety, we can see that Wall Street do have a very nice price target. They see 25% upside just over the next year. There will be different analysts. As we saw, there was the bull case that does see nearly 200% to May 2025. But as always, take these numbers with a pinch of salt. Now, in terms of MOS level, well, we start off as always at 10%. We execute on that if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that, we'll buy it just under $16. Then we keep going till it's near the current trading price, and you can see in today's episode, we do believe there is a large enough margin of safety, pretty much now trading at a 30% as well, which if you do believe in this company over the longer term, it does look like one to consider for the portfolio if you do have space for a large growth company. As always, though, as we can see, 30% margin of safety, 25% upside. Do let us know your thoughts in the comments below. Is this one you're looking to add on the drop? Have you added after it dropped massively just this year, around 50%? Or maybe for whatever reason, this isn't one for you. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and we'll see you all on the next one.